slowing economy, falling inflation, lower yields, all of that sets the stage for a stock market rally into the end of the year. So I guess the question is, why aren't people buying into that rally right now?
That's exactly what I'm telling you right now. Everything I just said, Aaron, is the answer to that question. That that's my thesis. Based on the data I'm looking at, I see inflation falling dramatically over the next several months. I see the Fed talking a tough talk right now. As soon as inflation comes down to 5%, 4%, 3%, that tough talk eases up dramatically. So I see falling inflation. I see a dovish evolution of the Fed over the next several months, and I see lower treasury yields. Based on those three things, I think stocks rally big into the end of the year. But if the other thing happens, inflation doesn't fall, the Fed has to stay super hawkish and yields go higher, then stocks collapse. The fear of that outcome is so real. That's why people aren't buying into this rally. They want to see more proof that inflation is falling. They want to see more proof that the Fed is willing to pivot dovish if inflation falls. They want to see more proof that yields have topped out. They're not seeing that proof. They saw that proof throughout June, July, and August. Inflation did top off. It looked like the Fed may be doing a dovish evolution. And then all of a sudden, some of that proof got eviscerated when Powell was like, no dovish pivot coming. So now people are resetting their expectations. And now it's back to a fear-based market where we need more proof that those three things are going to happen. Fortunately, I remain resolute and steadfast in the belief that we're going to get more proof on that front. I think the September CPI print due in a week is going to be very, very soft. I think it's going to be much softer than expected. It's going to show a rapid deceleration in inflation in the month of August from July. Going to be multiple months of deceleration. I think you're going to see some dovish Fed commentary after that print. I think you're going to get a dovish Fed decision in the September FOMC. I think they still go 75 basis points, but I think that the commentary from Powell in the Q&A in the press conference after that decision will be quite dovish about the course of inflation. Given all that, I think that stocks do head higher over the next 4 weeks, but we got to get to that CPI print. And the fear that it's going to be super hot is what's causing the super chop. And I think that super chop continues until we get more answers on the inflation, Fed, and yields front. We need answers there. Until we get answers, people aren't going to buy into this rally with high conviction.
So whenever we have these discussions, I'm always amazed at your knowledge base and how, all the research that you do, all the things that you look at, it just, in the end, it makes sense. But there's obviously going to be people that disagree along the way. Not to belittle the research that they do or the insights that they have, but what, in your opinion, puts you in the right where bears in this situation might be wrong?
Well, the bear thesis in a nutshell is inflation is embedded in the economy now. It's structural, that it's not fleeting.
Okay.
And inflation is going to stick around, and we're going to keep printing 5, 6, 7% for a while. And as a result of that, the Fed is going to keep hiking rates for a while and very aggressively at a very aggressive pace. And therefore, treasury yields are going to have to go from 3% to 4% to 5% or even higher. And in the event that they do that, PE multiples have to come down from 20 times to 19, 18, 17, 16, 15 times. And earnings growth slows alongside that. So you get a 20, 25% compression in the PE multiple with maybe a 10 to 20% drop in earnings. That leads to a 25, 30% drop in stocks. That's the bear thesis in a nutshell. And it all hinges, as you noted in the logic I just laid out, it all hinges on inflation. It all hinges on what inflation does. Is inflation structural or is inflation not structural? And for me, it comes down to one thing: technology. This is not the 1970s because we have technology. We have the internet. We have the cloud. We have automation. We have robots. We have globalization. We have so many disinflationary forces at our fingertips that they didn't have back in the 70s. Literally at our fingers that they didn't have back in the 70s. In the 70s, they opened up their disinflation toolkit and it was empty. Now we open up our disinflation toolkit and we have so many options. If you're an employer and you're worried about costs, you're running a restaurant, you're worried about how much you're paying your servers, your waiters, what do you do in the 70s? You can't do anything. You really can't do anything, right? You have to pay those people because you need waiters to wait on people. You need servers to serve people. You need a hostess lady or hostess person to host the restaurant. Now you can go and get a miso robot. You can go and get different robots to do things at the restaurant in place of that labor. Disinflationary tool. Let's say you're an office, you're a business, and your office costs right now, I mean, commercial rent and rent for everybody is soaring right now. You can't get rid of that office in 1973 because you need a place for your employees to go to work together, to communicate. How else are you going to get work done? Today, if I'm a business and I'm not cutting it on rent costs, I'm slashing that. I'm just saying, okay, no office. We're all working remote. Ring Central, Zoom, Slack. We can at Atlassian and Salesforce. We can do this all remote. We don't need an office. Disinflationary tool, boom, right there. So there are so many technologies at our fingertips that we can use today to fight back against the inflation beast that I really don't see how this becomes a structural multi-year problem. I really don't. If it comes to that point where it looks like it's really going to hit us hard, we're just going to start adopting these cost-saving technologies hand over fist. And then if oil becomes a big problem, we're just going to adopt clean energy hand over fist. In the 1970s, we were a fossil fuel economy that ride or die with oil, ride or die. There was no other alternative. Today, there's plenty of alternatives. Okay, now gas goes back to $8 a gallon. Time to get that EV. Oh, now my heating bills get 100, 200, 300 bucks a month. Oh, time to get some solar panels. You know, like we have alternative solutions today. And that's why I truly believe inflation is not structural. And that's the core of my thesis, that because of all of these alternatives, cost-cutting alternatives at our fingertips today that we did not have in the 70s, this is not a rerun of the 70s era inflation, but rather a period of weird transition time between, I mean, you just got to think about it, man. Pandemic. The world shut down. How? Remember seeing those weird photos of just Paris and New York and London just empty? Ghost. That's never happened before. Ever. Not even during World War II. Not even during wars. Global wars did that happen before. It's never happened before where the world shut down. It's not odd that 2 years after that, we're seeing inflation like we've never seen before since the 1970s. We're seeing the monetary policy or the fiscal policy that we're seeing. It's not weird. Weird events cause for weird responses and have weird consequences. That's it. It's this weird transition period. Fortunately, I really believe we're getting to the 7th, 8th, 9th inning of this transition period. That inflation's on the come down. The Fed's going to fight it back. The world is normalizing. Supply chains are getting back to normal. The only country in the world that cares about COVID-19 and lockdowns anymore is China, and I think they're going to probably get over that soon enough. The world is normalizing. Consumers were locked up. They got out their pent-up demand. Now their behavior is normalizing. Fiscal policy is normalizing. Monetary policy is normalizing. Everything's normalizing. So we're on the normalization side of the cycle, meaning that I think we're in the 7th, 8th, or 9th inning of this transition period. And come 2023, it's going to be back to a normal feeling, normal looking economy that's not paying back the weird pandemic aftershocks, you know? So that for me is the core of the thesis and why I think that the bear thesis doesn't make much sense, because the bear thesis hinges on inflation being structural. And I don't see that today. I don't see that really at all. Let's talk about housing. Okay. One of the biggest inflationary elements in the economy right now is housing. But we can fix that. There's so many cool and innovative projects coming out right now to fix the housing shortage. You have 3D printing. You have these boxable homes. You have these pre-built homes, these prefabs. Like there's so many cool projects and companies out there that are attracting a lot of investment dollars to ramp operations that can more quickly, more affordably, more scalably build homes and solve the housing shortage. And boom, fix the housing inflation problem, fix the rent inflation problem. We have that today. We didn't have that in the 70s. So food inflation, right? Let's talk about food inflation. Vertical farming. We talked about that on this podcast before. that is a huge source of new food growth that we haven't tapped yet, really at all. And we sure as heck didn't have back in the 1970s. So, new technology providing a way to solve inflation. We talked about automation, talked about the labor market. Anywhere you're seeing heavy inflation these days, I'll give you a technology tool that can help you beat that
Mm-hmm.
inflation. That's the difference between today and the 1970s. And that's why I remain very committed to this idea that inflation is on the way out. The
Okay.
market doesn't believe it as much as I do. So the market is going jing, 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 jing. I'm going to let the market do that because I really believe what I'm saying right now.
Mm-hmm.
Meaning that the market, as soon as more data comes in and more proof rolls in that this thesis may be right, the market will come
Mm-hmm.
around to seeing that, and then stocks drift higher and growth stocks lead that rally. So despite the June, July, August rally sort of fizzling out here and us, the market action recently looking weak, I remain very bullish about an end of year rally in stocks for the reasons that I just laid out, while fully acknowledging that the bear thesis may be right. But I think probabilities, we have to operate in probability matrices. I think the
Mm-hmm.
probability of the bear thesis coming to light is much lower than the probability of the bull thesis coming to light.
Thanks for watching HGI Clips. For the full episode, head on over to our sister channel at Hypergrowth Investing by clicking the link in the description or listen to the podcast on any of your favorite streaming platforms. We make new episodes every Wednesday, so make sure to check it out and subscribe to never miss any of Luke's Hypergrowth insights.